All right, hey everyone. It's Wednesday afternoon. It is 2:30. Market's been closed for an hour, and the USDA put out their WASDE at 11 o'clock. So let's go through what the numbers are, and so you can see exactly what changes they made, and then we'll look at how the price action responded to it. So corn, they raised the carryout by 75 million bushels, and they did that by decreasing demand. Okay, this should not be a surprise to anyone because this is what they've talked about. They didn't touch any other numbers. And in beans, they lowered the carryout, and they did that by increasing demand just a little bit. Now, corn's demand decrease came from the lack of exports that we've been talking about, and the bean increase came from domestic crush, and maybe some imports. I can't remember, or exports. I can't remember exactly, but mostly just, hey, look, the bean market's on fire. Everybody wants them. Nobody has them, and they're in high demand. So therefore, look, tighter carryouts. So initially, this is a bullish number for beans, and this isn't that bearish for corn, right? So why did everything close so far off their highs today? And in fact, corn came down about a dime from where the report came out. You know, old crop corn was trading about 635 when the report came out, and it closed at 626. And beans were trading about 10, 15 cents above where they ended up closing. And why did they do that? Well, here's why. Here's the acreage. 91 million acres is what the USDA told us to look for, and now look for them. And if you plug that in at 91% harvested acres with a yield of 181, which would be this year's trend line, and you add in the beginning stocks of 1342, and you assume that demand is the same, then our carryout swells to 2.5 billion bushels, which is an absolutely massive surplus of corn. And so therefore you need much lower prices, right? And now beans are also in a little bit of a predicament, because if you plant 87.5 million acres, you yield 152, and demand stays with what they said it is, which we actually have a more generous demand number here than what they have, then our carryout still increases from 210 to 378, which is not bullish beans at all. Now, it's probably not $8 beans at 378, but it's certainly not $16, $17 beans. So we're probably headed more back towards that $10 range than anything else. But this is a big problem. Corn at 250 at 2.5 is not even $4 corn. It's something less than that. So that's going to increase bearishness, or the market needs to go fix this imbalance fairly quickly, or else it's just going to get worse. Now let's take a look at what the charts look like. This is new crop soybeans. This is November beans here. You can see our cloud. I love to have the cloud on here because it just tells you simply where we're at. And we're choppy, we're sloppy, and that's because of this. That's because we're right in the cloud. We've traded both sides of it today, out the top and out the bottom, and we closed right on the bottom of it. Now let me take this off so you can see a little bit more clearly. There we go. Okay, so you can see once that is off, that we have this big upper shadow on this bar, which means, and we have a very, very small real body right at the bottom of yesterday's bar. So this is a bearish engulfing day. It's an outside day. It's a double close a reversal day, although it's not a key reversal because we didn't make a new high over here. But nevertheless, it's a bad bar, and beans could certainly roll over and work themselves to the downside. Now, new crop or old crop beans are a little bit more bullish, right? And we have yet to get out the bottom of this cloud. We did not have a bearish engulfing day. We did not have a double close key reversal. We did not have any of those negative technical developments on the old crop than we did the new crop, but still not a great close when you thought that we might get to blow up the outside, out the top side. So we retraded lower even with a tighter carryout. So that's not really a bullish situation. So I would say anything below today's low at 1510 is likely going to get sold, should accelerate down to these lows. And if these lows break, then on down we go. Probably I would guess probably close to that 1320 mark, which would be these lows from last summer. And if you stop and just think about it rationally for a minute, if the supply situation is less burdensome today than it was back here because of the Brazilian harvest, then it makes sense that we would at least trade back to that level, right? Pretty simple stuff. So I think we're going to be looking to sell beans on any additional weakness. We were hoping we'd catch a little bit higher price, but I just don't see that in the cards at today's close. And we talked about this in yesterday's video. You know, you only get the benefit of what you see right here. You don't know what it's going to trade like out here, but what's happening on the front edge of this cloud. Remember, these bars are quoted 26 bars back. So what this is telling us 26 days ago is that this level right here is a critical level at 1508. Now, if you look forward, 1508 is now a crossing point where a lower price will convert this to what we call a bearish cloud or a bearish Kumo, which is a sell signal on Ichimoku theory. And what had us excited about beans is that we were trading above where we were 26 days ago. We failed to break out of these highs. We've reversed lower. And tomorrow on a lower close, we're going to end up trading back down below where price action is, which is a bearish development here, on top of a new bearish Kumo, and potentially trading back inside the cloud. Those would be three bearish Ichimoku sell theories following a large engulfing shadow. So I think it will become pretty bearish pretty fast if prices were to roll over. To reverse that, they just got to go pretty much straight up. They've got to just get up and out of here and go break these highs up here at 1550 in order to negate that. So we'll see what the action brings the next few days, and we'll just go with it, whichever way it is. Now, here's old crop corn. This is the May contract. This consolidation area, you know, this is a perfect example. You've heard us say this. I don't know if you've been with us 5 or 6 years, you've heard us say this probably thousands of times, which is one principle: consolidation favors continuation, which is an extension of the theory of the friend is your trend. And this is certainly what this looks like. So 1, 2, big 3, here's a 4, now we're down in 5. We'll see if this, how far this goes. This means that the next move higher or sideways is probably corrective, and then something that will want to be sold as well. Now, I'm a little bit hesitant to say, hey, rush out and sell corn, even though it's a valid short position to take anywhere below, call it 640, 642, anywhere above this level would be a good stop, and you can just sell it and forget it and not worry about it. I'm a little bit concerned about that because of some of the shorter term indicators being pretty oversold. I don't know if the timing's great, but nevertheless, a sell's a sell, and certainly we were unable to hold any type of support today, and we ended up breaking it. For sure, a move below 622 will probably accelerate on down to the $6 level, and potentially below that. Remember, we're looking to 592, and below that, we're looking to 520 on new crop corn, on old crop. Can we get there? I have no idea. Price action will be our guide, and it is what it is, and you want to stay in that trend for as long as you can. Okay, let's look at new crop corn because it's even worse than old crop. Look at this sequence of events here. Here's a trend channel. If we mark from this point forward and then we snap this to here, which would be the intermediate point between these two. So you got a 1, 2, and then this whole thing is just a big downtrend. You can see we're breaking out the bottom of that. Even if I wanted to be a little bit more generous and connect it to the upper peaks and then connect it to these bottom lines, we still broke out the bottom side of the larger trend channel. So whenever you break out the bottom of a big trend channel like this, you should expect it to test the backside of it and fall away from it. And so I think new crop corn is looking down to 540, probably as low as 507, and I wouldn't be surprised to see that happen in this move, given the risk of that 2.5 billion bushel balance sheet that we talked about. Now let's take a step back further and say, how far could we really go in new crop corn? So this is a weekly chart new crop corn, expand that out just a little bit so we can see it with less, with bigger lines. This is just the low from last summer at 542. I would expect that to give way and likely trade all the way back down into the low fours before it really finds any meaningful support. You can see some natural chart support back here. You know, this is the range of 514 to 497. This range is 487 down to 461. And then this one is 461 down to 427. So really anywhere, any three of those zones might catch it if this 540 level breaks, but there's significant downside risk in corn, in new crop corn. And if you look at this weekly chart, you can see what we're doing. Yep, boom, we broke straight out the bottom of the cloud. We have a bearish Kumo. We're trading below where we were 26 weeks ago, and we've broken out of this trend channel. So this chart is not good at all. If you haven't sold, you need to be hedged because it's going to take some serious work for it to get back into shape. All right, so this is back to the daily chart. Again, no end in sight here. This looks like it's just going to continue working lower. Now let's look at the oscillators and see if we have any divergences. Remember, a divergence is a higher low with lower low prices. So lower low price, lower low divergence, lower low RSI. So no divergence there. What about stochastics? Nope, we haven't even rallied back above the oversold level. This is just continuing to accelerate to the downside. So no buy signal there. Let's look at force index. Force index, that's not a divergence because it's got to come all the way up and break the zero line in order to meet that qualification, which means that the bears never relinquish control of this market, even on this sideways consolidation. So that's super bearish. Just really nothing good to say about new crop corn. It looks like crap and should be sold, and it's going to take some serious buying in order to change that. All right, now let's look at wheat, because hey, something's got to be good to look at, right? And the answer is no, not really. We did have a long lower shadow here. It did have a small bullish engulfing day, but man, not convincing at all. It is a little bit oversold, but there's no divergences on this chart. There's only hope that it's maybe too oversold and needs to come find a selling point or a rally to a point where sellers emerge again. And so anything, even a rally back up to 850, even a rally all the way back up to here, with as bearish as this is, needs to be sold. I would not be looking for an uptrend in wheat anytime soon. I would be looking for a bigger downtrend. Now this, I don't mean to put this out here to be the bearer of bad news and depress everybody, but I just want you to be aware, and I want to be realistic about what you should or may need to expect from wheat moving forward, okay? So this is the weekly chart, continuation chart of Kansas City wheat going all the way back to 1992 on the left. This is today on the right. And what you can see are the big spikes we had, right? We had this big spike in 06, and we just had the one from last summer. Now we had this little secondary peak, second and third peaks right here in the summers of 2010 and then 2012 that coincided with the other commodity moves. And what you can see is that we have failed now to hold those vertical lines of these support zones. And so when we come back lower, what I want to show you is where we traded back through, right? We came down when we reversed right about this 855 level. And what I want you to see is where we have reversed from on this little down sequence. We came down to this 850 level. We bounced back up above it. We've now traded back down into it, and we're not holding it. And so I think what comes next is probably something that looks like this. A big, long, nasty decline that's going to take us back below the levels of profitability in wheat. And that would coincide with the 2.5 billion bushel corn carryout too. So Wheat's downside is significant and should not be ignored, even though it's down as far as we are. You know, we could easily take wheat and put a 5 in front of it, or even a 4 from these levels, and trade right back down into this range that held us from 15 through 2020. I know that's depressing. I know that's going to make you want to throw your lunch back up, but the reality is that's what this chart is telling us, and that's what it looks like. Now let's look at the weekly. And you can see it even a little bit more granular here. Here's the $8 level. Here's the congestion zone that we had before the war broke out, and we're trading right on the bottom side of that congestion zone. Okay, zoom in on it just a little bit so you can get a clearer picture. Here's this congestion zone. We spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18 weeks in it. We have now spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16 weeks here, bouncing between the upper boundary of this zone and the lower. And here we are consolidating right near the bottom of it. So I would expect at least a test of 742 and probably lower than that before it's all said and done. And our Fibonacci targets, which are drawn off of this extension and this retracement, count all the way down to that $5 and $4 mark that we talked about. So you need to really make sure that we're communicating and talking. And again, our job is not to scare you. Our job is to communicate to you when we see downside risk that could affect and hurt your farm's profitability, right? Because let's face it, when we say, hey, we see upside and it goes up, everybody's happy. When there's significant downside, and if we're not screaming it from the rooftop here, then nobody's going to be very happy with us. So we see downside, we see risk to farm profitability. You need to be hedged, and you need to be hedged pretty far out, because these drops could be significant. And I'm not making this up with voodoo. In fact, right, we're using some objectivity here and just looking at acres times yield times plus carryout minus demand equals that. And our carryout is probably going to be closer to this than it is back to this, without some sort of a weather scare or some sort of a demand surprise that comes from somewhere that the USDA is telling us that we're not seeing. Remember, the USDA has trimmed this number from 14.55 billion earlier this year. It's just continuously decreasing the demand, and our weather is improving. So lower we look. All right, I know that's depressing, but want to put some clarity and some context around these charts and the price action for you, and let you know what we think is going to happen in the nearby, and what we think is going to happen long term. So to summarize, wheat, we could see a small little bounce, but long term, we think it's got to be sold because we're heading much lower. Corn, that carryout's growing too far, too fast, and the market's job is to discourage that. So we think it's heading significantly lower. And beans, looks like their carryout is going higher as well, and supply is abundant. So look lower there as well. So I know that's hard to hear, but the numbers are starting to come in to prove it out. Remember, there's risk trading commodity futures and options, and you should only do so in light of your own financial condition. A little bit of housekeeping. I'll be out helping sponsor a trip for teenagers over spring break, so we're going to be gone. I'll have my phone, and we'll do our best to be responsive to texts and phone calls and emails. But otherwise, please call Jeff and Phil. They'll be here manning the shop. If you need anything executed or need to bounce anything off of anybody, they'll be available to you. And they'll be shooting videos throughout the time that I'm gone to stay communicated and to keep those chart pictures in your head. With that, we will talk to you guys next week. I hope you have a terrific day.